hopefully
Yeah.
my voice isn't getting a lot of feedback.
No, you're sounding good, Christian.
Okay,
And
good, because
yeah,
I'm getting feedback on my side. Anyway, good afternoon. Thanks for taking the time to speak with us. I'm Christian Petersen. I'm here, Christian C.B. Petersen on the forum, here with Eric Rapp, who is EU Menace on the forum. And we're here to discuss the differences between TradFi and the MIP6 process with Maker.
Christian, I'm getting some kind of feedback on you. I wonder if anyone else is.
that sounds good to me.
Okay.
Okay, well, let's just keep going.
Sure.
So if you could move to the next slide, Retro. So just an outline of the presentation, just to review the MIP6 process, the role of real-world finance and the incubating legal and transactional services core unit, a discussion about TradFi, and a little discussion about the current self-contained MIPs that have been submitted to the forum with the concept of prioritization. Next slide. So just to discuss MIP6 and just to kind of set out some facts for the community to understand. First and foremost, no MIP6 application is the same. And what that means is the MIP6 proponent, the underlying asset, the credit quality, jurisdiction, proposed economics, etc., are going to vary from MIP6 application to MIP6 application. We try to address that diversity, and the diversity is great. It just makes things a bit more complicated. We try to address some of the complication that arose from that diversity by publishing in mid-January a methodology for structured finance. And that was to identify some general principles that MIP6 applicants should try to follow when submitting an application. Again, trying to homogenize a little bit the process. Which goes to my next point, which is finance agreements themselves are not homogeneous. And what I mean is we don't prepare the initial terms and conditions, and that means that the terms and conditions are going to vary between MIP6 applications. Unfortunately, finance agreements, even in the real world, let alone in DeFi, are not like in ERC20, where it's fairly standardized. You know, applicants use different forms, different language, draft things in their favor in the first draft, leave things out. So, we have to end up spending a lot of time actually reviewing what the finance agreements say. Some of the applications, or many of, they're getting better, many MIP6 and self-contained MIP applications actually do not provide a fully defined transaction structure. None of them actually provide us draft transaction documents or even a term sheet to facilitate a comprehensive and meaningful review. And you'll see why this is important in the next few slides. So next slide. So what is the role of the real-world finance team and the legal and transactional services team? So let me just to give you an example. So MIP6 applicant proposes a commercial term. So I've identified this term. And by the way, there's hundreds of terms in a transaction, but just for example, you have term one. So the first thing that we do is determine whether that term is, quote, acceptable. Okay, what does acceptable mean? Acceptable means that we look at that term based on reasonable market standards. So if it's a real estate deal, we kind of try to understand what the real estate market has for that particular standard. If it's a solar financing deal, we look at what solar financing does in that particular market. If it's a green hydrogen transaction, we try to, there's not a lot of green hydrogen transactions out there, so we would try to do a comparable, like, for instance, liquefied natural gas would be a comparison to green hydrogen or natural gas because they're both gaseous energy types. So we try to determine what would be a reasonable market standard based on the asset class. So then what do we do? So we look at it and say, okay, is the term acceptable based on reasonable market standards? And if it is, we move on to the next term. Well, what if it's not? Okay, so could the term be acceptable if it is modified to be term 1 plus A? is it okay for us to propose an adjustment to the term? Is that a negotiation? Well, what if term one is better? It's actually better, so it's not just acceptable, but it would be better for Maker if the term is modified to include B. So it's now term one plus B. Is that okay? Is our role to look out for the best interests of Maker by proposing a term that may be better for Maker than just term one plus A? What if the term isn't acceptable at all? Can we counter-propose? Can we counter-propose term 1A? Can we counter-propose term 1B? Is that something that we, as the real world finance core unit and the legal and transactional services core unit, are we authorized to do? So moving on to the next slide. So what is reasonable? What is market? Whose market standard? And are any of the counter proposals and examples 2, 3, or 4 where we are, quote, countering? Is that a private entanglement? The term private entanglement seems to be thrown around a lot in the community. Are we engaged in a private entanglement because we are proposing a term that may be more beneficial to Maker? Are we negotiating? There seems to be some concern within the community that we are negotiating. Well, if an applicant proposes a term and it's not acceptable, is our role just to say, well, that's not acceptable? We'll just that's the end of the story. We move on to the next point, and then give a response to the community on a point-by-point basis that this term is not acceptable? Or, are we at that point exceeding our role as assessor? In the real world, you would negotiate. You would say, okay, well, I get term 1, but term 1A is better, or term 1B is better for Maker. I don't necessarily, as a lawyer, I don't necessarily view that as being privately entangled, or certainly it is negotiating. We're trying to get better terms from Maker. Is that okay? So next slide, Retro. And it really all comes down to a little bit of a debate regarding decentralization and centralization, and the role of the real world finance and legal transaction and services core units in this process. Now, as a lawyer, to me, everything is on a spectrum, and I can find a point all along that spectrum. But first and foremost, I want to make sure everybody understands we are very, very clear, abundantly clear, that we do not approve, reject, or that basically Maker governance approves, rejects, or modifies transactions in all cases. All we can do is, in some sense, try to get the best deal for Maker and make a recommendation. So when you look along the spectrum of decentralization and centralization, on the extreme of decentralization, we would basically, quote, accept whatever the MIP6 applicant proposes and only do an assessment. We would not go back to the MIP6 applicant and say, hey, this term might be more acceptable if it was 1 plus A rather than just A. That's the extreme of decentralization. There's an extreme of centralization where we prepare the underlying agreements, we control the entire process, and frankly, in the real world, most lenders are on the side of centralization. Now, even as much as whose counsel prepares the documents, typically lenders' counsel will prepare the documents. That means we would, in theory, if we were the lender, control the entire process. We've taken a view that that's perhaps too much centralization. We will allow and encourage the borrowers to prepare the documents, because the person who controls the pen controls the process. So to us, that kind of leans towards decentralization. So it's really a question of where in our role do we fit in that spectrum. And I think one of the things that is, as we have seen more MIP applications, we've seen more self-contained MIP applications, honestly, we are trying to find our way where we are in that spectrum, and it moves. You have people coming from a traditional finance background, like Eric and myself. Our natural inclination may be for more centralization, just because that's what we've spent decades doing. But we also recognize that Maker and DeFi is different, and that we need to slide towards this side of decentralization. And it's really just finding where along that spectrum is the best fit to ensure that one, deals can get done, and two, deals can get done that are beneficial for Maker.
Hey, Christian, can I give an example on that?
Please.
To Christian's point, let's say it's a term that really matters, and the prospective borrower comes and they want 100% advance rate. I want it too. So essentially, when they make a loan to someone else, we give them 100 cents on the dollar, so they have really no equity, no skin in the game. And perhaps in the real world market, maybe they ought to begin 80% advance rate typically, and they come to us and ask Maker and ask for 100%. It's really a fundamental question of how's Maker going to think about that. One, it's way off market. If the real world's saying it's 80% and they want 20% more advance rate, what they're really saying is, hey, we want to be cheap and not have to spend the equity out of our pockets. Normally you need to raise equity, to help build your business and, give the lender some cushion, some, first loss position. And they're basically telling Maker, hey, we don't want to do that. We want to, to have all the upside and you get all the downside. And so how is Maker supposed to, make a decision on that? To some of us who've been in the business a long time, it's kind of absurd, but we do get these asks, and it's really, I guess we want to ask Maker as a community, how do you want to think about these things and respond to them? Because I could tell you, yeah, it looks stupid or it looks ridiculously off market, but it's not my place to say no. I'll just say, hey, it's ridiculously off market. No one in, no real world lender would do that. But if Maker wants to do it, God bless them. But I think think about things like that, because we get some way, way, way aggressive asks. That no smart lender, from my perspective, who'd been in this business 20 years, would do. They'd laugh at you and say, leave. Okay, next slide, please. All right, so when in the traditional world, let's talk about how they do a structured finance transaction. What's the process? How do they do things? What do they look for? First, let's think about what are the lender and the borrower looking for? What are their priorities? Then we're going to talk, typically, the borrower, is going to be seeking financing. Then the borrower is going to prepare and propose some type of offering, to potential lenders. And usually you don't go to just one lender. Having been on the other side of this, we'd probably start out with 10 or 15 potential lenders and you funnel it down. You typically want to be able to get a few different offers, and have some idea of getting, the best terms out there. So in a sense, I get a little worried when lenders come only to us, and we seem to be their only target to get funds. It puts us in a weird spot. But assuming like the borrower presents something that makes ballpark sense, they will engage with the lender, the potential lender. I call this an initial engagement. And then we'll talk about these steps more. Then they'll go on, if they both agree roughly on here's a deal, you will call that a term sheet. It's a written agreement that isn't binding, but in a sense, both sides are saying, here's the rough terms we think a deal can be done at, and let's do a lot more work and make sure it works. And I'd say probably more often than not, the term sheets actually go on and closes, but sometimes, particularly, you'll find lenders may back out because they'll find what they were told by the borrower, in the early stages, it isn't really quite true. They've made things a little more rosy, and it turns out, the reality is messier. All right, then let's talk about, post term sheet to closing. Once you get the term sheet, how do you actually go from this initial guidance document to a binding deal or not? Then let's talk a bit about, the kind of key terms, and there's many of them. And then also let's talk about TradFi versus a DeFi onboarding process. Just to step back and think of some of these points. There's definitely some key points to think about. So next slide, please. All right. So what are the priorities? Well, as a lender, you want quality collateral, right? That's very highly likely to repay the loan. You're not in the business of losing money. And if your typical lender, stuff we're looking at is probably getting 2 to 4% interest rate a year, you you can have very few losses, and even break even. Just think about that. If you get a 2% annual interest rate and you suffer a 5% loss a year on average, you're giving away 3 cents out of your pocket a year, right? That just doesn't work. So if you're going to have a low single digit interest rate, that's telling you your interest rate's your risk level's got to be low. And so the lender wants to have people that repay them. They also want an efficient, transparent, and consistent review process. Why do you want this? It's not just you're a good person, though I think this is fair. You want to attract quality borrowers, and good borrowers want to work with, good, reasonable lenders. You don't expect the borrowers don't expect the lender to be your friend, but you want to know where they're coming from, and think like it's a reasonable process, where both parties are engaging in good faith and trying to get to a good result, i.e. a transaction. And what are the borrower priorities? Well, of course, they want a good, predictable review process. They want to engage with lenders, that they think they have a good chance of doing business with. The borrower wants to have someone that once they agree kind of on key terms or come to a term sheet, that the lender has a reputation that's earned, that they actually, they will close on the kind of term sheet. They close on most of their term sheets. They don't walk away in the middle of transactions unless there's a really good reason. Yeah. And when you think about once the term sheet's agreed to, that's when you start spending a lot of legal bills, actually documenting things. And typically the borrower pays this. So again, they only want to start working on legal documents with lenders that are, or have a good reputation and it's earned for following through once they say they like a transaction. Next slide, please. So how does it start? Well, the borrower, for some reason, needs financing. And how do they do this? They're going to prepare a financing proposal for potential lenders, essentially like a memorandum saying, here's who we are, here's why we want financing, here's what it's going to be used for. And then typically they'll make it kind of a term sheet proposal, maybe a 5 to 10 page document outlining key terms. A number of the key terms, they might leave the specifics blank, but they're just trying to show the lender roughly what they're looking for. Typically, a borrower may engage an investment bank. Kind of think of this as a structuring agent to guide them. When would they engage an investment bank? Because investment banks, it's not cheap. They'll probably charge you at least 1% of the transaction. So if it's $100 million, they're going to charge you $1 million. Well, if it's an inexperienced borrower who's not used to this, the investment bank typically will be an expert, in this asset class. And so not only do they know the asset class, but they know a whole bunch of potential lenders. So they're going to, kind of take you out and introduce you to maybe 15, 20 lenders that they think are relevant to what you want to do. And they also help you put together, your proposal. Two, if it's a very complex transaction, even if, you've done transactions before, if you're adding something really sophisticated, often you want to get these hired experts that just know how to do these things really well. I mean, that's their expertise. They live on it. I mean, as I kid with Christian, there's a reason, like one of the lawyers we've used is Sherman Sterling. He's a great lawyer and he lives in a $5 million house. Why did you live in a $5 million house? Because he's exceptionally good at what he does and people want his advice. And I don't begrudge him his money. He's really good. And finally, if you're not just looking for one lender, if you're looking maybe more securitization where you're going to have dozens of more public bond investors buying your deal or investing in your deal, then you probably are going to want an investment banker because they're going to know the investor base to reach out to. If it's public bond securitization, they could be reaching out to 100 investors, and they have a whole sales distribution arm. That's very valuable. Most companies don't have their own bond sales distribution arm. And so what are investment bankers good at? I pretty said this thing, so let me just kind of highlight it. They know asset finance capital markets. This is what they do. They know where the potential lenders are. They know what reasonable terms are for transactions. When you think about if I'm like an auto lender, looking to go, get a bank line against my portfolio of auto loans, I might not know roughly what the terms are. The investment bankers will say, look, you probably will get 75 to 80% leverage, and kind of outline the whole range of what's reasonable and help guide you in the negotiations. And, if you want to push one point into the negotiations, they'll probably say, okay, but maybe you ought to give up something else if you really want that one point. So they're just experts in kind of knowing where the market does things. And they're very good at kind of backdoor channeling with lenders, to be kind of the middle person in the negotiations. It helps keeps things get from kind of too tense when the lender's like, I want this, and the borrower's like, is no. It's good to have that middle guy kind of keep, things calm. They're also, as I said, very good at structuring and negotiating deals. And finally, I think it's underappreciated, but they're very good at managing a transition from beginning to end. It's not easy to do. There's lots of commercial terms, legal terms, all these different things have to be done. And part of what they do is just manage the whole process, which is very valuable. Next slide, please. So how does it go? Well, the borrower starts by preparing and proposing. They put together this financing proposal to potential lenders. What is it going to cover? Their origination platform. That just goes like, what do they need the money for? Who are they owned by? Who are their management? How do they originate assets? Loans. How do they underwrite them? What's their credit process? How do they serve them? Service them. I.e., monetize the payments. They're going to want to also prepare how's their assets performed historically. When lenders look at borrowers, what's your best predictor of how their portfolio of assets will perform? Probably how they've done over the last 4 or 5 years. And then it'll also have some, commercial terms and legal structure proposed. What are they looking for roughly? Not down to the last detail, but the lender wants a rough sense. What are you after? So they can decide whether they care enough to look more. And this, again, this is important to have like this level of kind of expertise in putting this together. It's typically very difficult when a lender who doesn't really, a borrower doesn't know the market and know what they're looking for, and they just show up and say, we want money. And as a lender, you're like, okay, but there's just dozens of things to be addressed. So if the borrower doesn't know much, you typically would expect the borrower to have a smart legal counsel to guide them on legal structure, and then some kind of asset finance banker who can guide them on how this is done. It's a complex series of things to be done. And if the borrower really doesn't have a good idea what they're doing, it's very, very time consuming and difficult to close a transaction, with inexperienced borrowers without the right counsel. A number of lenders will probably just choose not to engage. It's just too difficult. Next slide, please. All right, the initial engagement. The borrower approaches the lender, with their proposal. The lender is going to have an initial discussion, review with the borrower. So, what is the lender going to do? I've been more in the lending seat than the borrowing seat, but so in a sense, the lender wants to say, hey, does this asset and proposal meet my risk appetite? If I only want short duration assets or only investment grade assets, does it check those boxes? At the end of the day, when you're a lender, you're really looking to throw everything out really quickly that doesn't meet your key hurdles. You don't want to spend any more time than you have to on stuff that's not going to make it. So does it meet your risk appetite? And then also you're going to look at what the proposal terms are. If it meets your risk appetite, is the borrower asking for kind of ballpark terms that seem reasonable to you? If you like auto loans, but they want a 95% LTV, and 85% is about as high as the market goes, it's probably not worth spending a lot of time on them. Once you tell them that, and if they don't change their view, you probably want to move on. And then the lenders go, assuming the lender says this is in my risk appetite, and the borrower is asking terms that seem reasonable enough ballpark. That the lender will do some initial diligence on the borrower and the proposal, looking at the key issues and key risks and terms. Then the lender will negotiate the key commercial terms and legal structure. This is going to go into a term sheet, which again, it's signed by both parties, but it's more just an indication of serious interest. It's not really legally binding, but again, it's a reputational thing. When you're a lender, you don't want to be known for breaking term sheets unless there's a very good reason, or people just don't trust you. Next term, please. Next slide. All right. So the lender typically will propose the term sheet, though. It can be a back and forth. It's going to document the key commercial and legal terms. It's probably typically 3 to 20 pages. So there can be a fair amount of depth in it. If both parties, agree to it, and you're typically not going to produce one unless you think you're going to get there. Then it's accepted in essence. Both parties sign it. The lender then begins to do confirmatory diligence, which is basically just trying to confirm all the points that they think is true. The borrowers presented a lot of things and said, hey, our annual loss rates are 4%. And maybe you've seen some high level data, but typically say the lender, might actually go in and look at the underlying data, or actually probably will, maybe even get it audited. So if the borrower says it's a 4% loss rate and the audit shows it's a 12% loss rate, you could lose a deal like that, right? But both sides are usually professional and try to be, open and upfront, because that's a bad outcome for everyone. Then the lender's counsel typically starts drafting legal documents. This is expensive, right? So you don't want to start this step until you think you're close to getting there. Then the parties are going to negotiate the remaining items in the legal documents, with counsel on both sides. And even though the term sheet might be 20 pages, by the time you're done with these transactions, Christian, there's probably at least going to be 4 or 5 documents and hundreds of pages. So there's lots of other points and some of them material that still have to be discussed. Is that fair?
Correct.
Yeah, so there's a lot there. And usually it's going to be aimed to be closing this within 90 days. It's just you want to drive to a close. You want a sense of urgency. Sometimes people will have to extend it, but the goal is, to really get this thing done. And then typically a borrower in the real world will agree to an exclusive negotiation period with the lender. Because if you're a lender and you say, look, if everything you told me is true, I'll do this deal at these proposed terms. You don't want the borrower then doing that with 3 other lenders. And then they finally get to the last minute, and they say, oh, sorry, we have a better deal. So it's typically a lender is going to want that kind of exclusive period for, say, 3 months. And again, it's really a question of operating in good faith, and there's some games going on around here. But I typically find that it's just better to work with parties that are transparent and really kind of follow this rough process so they're reliable. In kind of a game theory sense, it's not just one transaction. If it's just one transaction, maybe someone's going to try to screw you as much as they can. But if you're probably going to be working with them over the years, you understand that both sides need to have something that makes sense, and you really should treat each other well because you want to preserve a valuable long-term relationship. Next one, please. All right, post-term sheet to closing. So we've already started talking about this. How do you get to closing a transaction from the term sheet? The lender does the confirmatory diligence. The parties complete the remaining negotiating items, and this can be a fair amount in the legal documents. The lender's counts, typically will be the one drafting it. The lender in the real world, and this is centralized, likes to be in control of drafting the documents. Why? Because then they get to be written just the way they want them. That really, addresses the risk in the tightest manner that they're comfortable with. You can have the borrower doing the documents, but it makes it harder if you're the lender, because the borrower potentially will write dozens of points to his advantage. And, you might have to go back to many points and say, no. And that can be a mess. And this, again, needless to say, presents issues in decentralized finance, whether there's going to be negotiation or not. From my own perspective and experience, a borrower writing their own documents without really an active kind of oversight from the lender is just it's a train wreck waiting to happen. There's a reason why it's not done in the traditional world. I personally think it's an exceptionally good way to lose money. And then transactions, once they get to term sheet, I'd say more often than not close, but they still might not. Why? And as I've already hinted, the lender's diligence might discover some important undisclosed risk. Say the well, one of the owners of the company, has some criminal convictions on fraud. I've seen this. There's lots of little ways things can go sideways. Or the borrower and the lender cannot agree on some open points, that weren't specified in the term sheet. There are still other points that matter. And you try to get those up front at the beginning of the term sheet, but you don't always cover everything. It's the nature of the process. Next slide, please. I just threw down, off the top of my head, some of the key terms in transactions, and this is by no means everything. This is probably maybe 5%. I don't know. These are key ones, but there's so many more. So I really want people just to think, when you do a structured finance transaction, there's many important terms, or material, if you will. Let me give you a quick list of some of these. How big is the loan? How long is the loan? What's the advance rate? What's the interest rate? Those are all kind of obvious. What's the credit policy? How did they decide on making their loans to, if it's auto lender, how do they underwrite people? Are they allowed to approve or change the credit policy without your approval? That'd be a big problem, because, you signed up to them doing this historically, and they say, oh, we suddenly want to do a whole lot more risk too. So you don't want them to be able to change it materially without your approval. What's the servicing policy? How do they service delinquent assets? Do they have to get your approval to amend the servicing policy? Do they need a backup servicer? How does the underlying loans need to perform? Are there triggers? if things aren't going well, where are the triggers, what levels? And then if the triggers are hit or other things are, go wrong, like, what are the events of default that let the lender come in and shut down the situation? These are very important. When things go sideways, you as a lender want to be able to come in and get control of the collateral and if needed, shut things down and liquidate. There's a whole lot going into this. And then also, what are the priority of payments? Who gets paid when in your typical monthly waterfall? So every month, all the cash from the loans outstanding comes into an account, and who's getting paid when. Very important. Does the originator, write reps and warranties as to, like all of the underlying asset loans they make are actually done in accordance with their credit policy? For instance, if they do some sloppy things that are out of policy, they should be expected and required to buy them back at par. I could go on and on all these things. I think I want to make the point that there's so many important elements, to deal with here. And I kind of say this as a joke, but let's say Maker, made a loan to Christian and Christian and I aren't special. We're just experienced. And if Maker got its top 20 or 30 terms and we got to figure out the rest of the terms, say it's $1 billion loan, the loan would perform. You never see a penny back, but we wouldn't have broken it. We just have our own islands and be very comfortable. Not because we're that smart. We've been in this long enough. How to carve things out. So there's so many ways to carve out risk and reallocate it. So it just when you look at these things, don't think the top 15 or 20 key terms are enough. Usually if you stay on market, that's enough, but someone's got to be there to say, hey, the rest of the terms are on market. Don't assume they are. It's kind of trust, but verify.
And Eric, I would just add on this particular point, I mean, these go to the discussion I had at the beginning in terms of negotiation, right? There are tens of dozens, hundreds of these points, and we, in our review, will need to determine whether, for instance, the events of default, are they market?
Yeah.
Which ones are missing? Which ones maybe should we have, given that the borrower is borrower X? What are the cure periods? Are there any cure periods? Are they too long? Priority of payments, reps and warranties. Are there reps and warranties that are missing? You'd be surprised in some of the agreements that we've seen that reps and warranties are missing. What about the covenant package?
Yeah.
So these are all things that we need to look at line by line.
Yeah.
And covenant rep section by section, just to determine whether that particular clause is there, and if it is there, is it market? If it's not market, is it fixable or not? And then finally, do we want to fix it given any number of other issues that may be in the agreement?
And the other thing I'd say is, like, again, think of you're an auto lender. We think of making a loan, $100 million Maker does to the auto lender, and they give us 120 million of auto loans. The kind of the thought experiment, how I look at this is, they give us 120 million of auto loans and we put a corral or a fence around it. Then the question is, think of every way we could lose money with that collateral deteriorating or slipping out of the fence. So most of what's going on here is how do you make sure the collateral in that fence is what they tell you it is, and how do you make sure it's well maintained and it doesn't leave the fence, and all the cash from it goes to you if needed. And on one hand, that's pretty intellectually easy. On the other hand, there's a lot of moving parts to make sure that happens. That's really kind of probably the essence of the structured finance game. How do you kind of identify and control the collateral that's backing your loan? It's so much more complicated than in crypto lending. Crypto lending, there's a real beauty in being able to take wrapped BTC, into our vault, and liquidate if needed. You don't have that in the real world. So yeah, next slide, please. I want to give a rough sense of here's some off-market transaction examples with some of the points I've made. And then just think about how should Maker be dealing with these potential situations, because all of these things under borrower proposal, Maker could get asked, and how does it want to be able to decision or negotiate these? What if they propose $1 billion loan, and typically the market might give them 100 million because they never, done more than 50 million, their books, maybe 60 million, and they could grow to 100 million in 18 months. No sane lender would give them $1 billion, but they can ask. What about advance rate? As I've talked about early on, maybe they ask for 100% advance rate where the market's more 80, and there's good reasons the market's 80. They need to have a first loss position. We're not their equity, typically as a lender. How does Maker want to address that? What if they have a very loose credit policy, and you're not really comfortable with what they're doing, where the market would want it to be, more controlled, maybe like only FICO's above 650, not below 650. What about approving changes to the credit policy, where the market would say, yes, the lender has to approve the borrower changing their credit policy, but they don't want to approve it, want us to have approval. We've got deals, this has been asked. What if the asset performance triggers are pretty loose? So think about this, you got all your loans in the fence, but they start going really bad before the lender can do anything. Tighter triggers means you step in sooner. We certainly get proposed weak performance triggers. I could go on and on about all these, but there's just many things they can propose that are not only off market, but underneath off market. What does it mean too? It typically means there's a higher level of risk there, and if the market wouldn't do it, or if there's a higher level of risk, it'd be priced differently. In a sense, there could be a price for everything, but it might be a much higher price. So they're asking for the low price with the high risk structure, basically. All right, next slide, please. Oh, hey, Christian, do you want me to defer to you on this one? This is kind of getting near our summary.
Yeah, so this is really just a slide to, I think, summarize in a way how TradFi and DeFi onboard an asset. I mean, we've covered a little bit of it, but I want to maybe make it a more pointed comparison. TradFi institutions have a structured, very well-defined collateral onboarding process. We have a MIP6, which is developing into a structured collateral onboarding process. But frankly, we haven't. We've had a number of applications, some within the MIP6, some outside the MIP6. So we're working on defining a structure, creating that structure. Most TradFi institutions know what they want to lend to and have a risk tolerance. We sort of do, right? I mean, there's this theory for clean money, but even that is fairly broad. What is clean money? What is the risk tolerance that we're prepared to accept in clean money? Would clean money, for instance, I mean, I've spent my career in energy, so does clean money, involve liquefied natural gas because it will reduce coal consumption in Europe? Well, gases and methane, is clean money would clearly include green hydrogen, but, there's not been a green hydrogen project implemented on a project finance basis to date. So there's a whole bunch of technology and commercial risk. Is that a risk that Maker would be prepared to accept? Most TradFi institutions will have a benchmark in which they can review transactions. They would have a separate business development team that initiates the engagements. They would have a deal team that performs the structuring and the negotiation of the transaction. And then ultimately, they'll have an investment committee that has kind of the ultimate decision power. And that investment committee is comprised typically of senior experienced professionals within the institution. So how do we look at it? So we're continuing to define our onboarding process. It's not structured yet. We're working on it. Do we have a focus? Do we have a focus on preferred assets? There's been discussion regarding investment grade, short duration. We have the clean money thesis. There's a question as to ESG and what is ESG? It's greenwashing and the like. We seem to be investing or having applicants that are proposing assets in highly competitive markets like the US. So we're competing against commercial banks, particularly in such areas of solar financing and other green financing. We want to use market type of structures and pricing as a benchmark. I think what is clear is the growth core unit is undertaking the business development role, and we have been working closely with the growth core unit to really give them an idea of, okay, you guys are the business development folks. Here's kind of some of the things you need to be looking at, because that has typically not been the function of Growth Core Unit, to be onboarding real world assets. But we're beginning that communication, that collaboration with them, so that when they're out in the market, they can kind of have an idea of what are some of the benchmarks and standards that we're looking to bring on board. I think there's still an open issue as to the role of real world finance in the incubating legal and transaction services core unit. Is the assessment role adequate for incomplete MIPS? Often structuring and negotiation is needed. Is that okay? Is the community on board that the real world finance and LTS core units will be delegated some level of authority to structure and negotiate transactions? I think we're still learning, both at the core unit level and at the delegate level, and in the community, frankly, how we are best to support their decision process. We are using sessions like this to really be able to find a way to communicate with the community, find a way to communicate with delegates, do it through multiple means. Some people adopt information or absorb information better if it's in writing. Some people absorb information better if it's in a presentation. If it's in writing, is it a memo? Is it a slide? We're trying to find our way to really be able to support the delegates and the community in the decision-making process. So it's a continued, continual process. We're not perfect, but we recognize that we want to get to a place that has a little more structure and can give the community and the delegates confidence that there is a structure that we're following. Next slide. So then what I'd like to discuss is the self-contained MIPS that have been proposed to the community, because frankly, these are outside of the process that we have been, actually directly contrary to the process we've been trying to establish. There's nothing wrong with a self-contained MIP, but just for people to recognize, when you're seeking to develop a process that is transparent, that is efficient, that is understood, albeit not perfect yet, having self-contained MIPS with a prioritization built into them kind of throws that endeavor a bit into doubt. So several of the recent MIPS have sought to skip to step 5 of the collateral onboarding process. And there's a link specifically there to what step 5 says. And step 5 says here that domain collateral assessments are created and published in the Maker forum while awaiting the posting of a governance poll on the following Monday. We are then, the various teams, we need to provide an in-depth evaluation of the collateral type with the goal of the assessment to provide information to help inform the MakerDAO governance community. So, when these MIPS come in to Maker, unless they address the standards that we've identified in the methodology for structured finance transactions, and frankly, include the full suite of drafted transaction documents. And what I mean by that is they send us a loan agreement, they send us the security, the pledge agreements, the collateral account agreements, the cash waterfall, everything fully drafted in a document. It's going to be very difficult for us to say to the community, yes, this transaction looks good. Because what happens is, once the MIP is approved, we're then asked to provide an in-depth evaluation. But unless we have a very complete set of documents and an very complete package, we fall back into the kind of in where we are now in the MIP process, where you end up having to have a discussion. Are these terms market standard? If they're not market standard, can we propose something? Well, it's unclear to us what our role is and what happens after if a MIP, self-contained MIP has been approved. And to the extent that there is a self-contained MIP, really the only way that we can provide a very meaningful and thoughtfully responded to assessment is if there's a full suite of agreements, because then we have the full package that we can review. Obviously, if if an applicant doesn't provide us the full suite of documents, then they need to then go off and prepare the documents after this has been approved, and that can potentially delay our review of other assessments because of this prioritization concept that has been included in some of the MIPS. So they give us a MIP application that's not complete. It has a prioritization language in it. They get prioritization and kind of a focus on their MIP if it's been approved. And then we can't do anything until they actually provide us draft agreements. Well, it's going to take them time to prepare the draft agreements. So we basically sit on our hands doing nothing with respect to all other assets while the borrower controls the pace of the document. And that doesn't seem right. And that's why we say, actually, if you're going to do the MIP6 application, you need to have the full suite of drafted transaction documents, because that's really the only way that we can review the entire transaction in its entirety and be able to be responsive more quickly in a way that's not then delaying every other MIP that is in front of the core units. Eric, I think that's the last slide, Retro. Are there any questions? I don't know if people can ask questions.
If we have questions.
Yeah, I haven't seen too many questions get dropped into the chat yet, but if you have them, please fire away and we'll be happy to answer them. I wanted to kick things off by revisiting the MIP67 that's currently up for a vote. How much of the challenges that you guys just described is addressed or isn't addressed in MIP67 in its current version?
I think on MIP67 we're trying to address nearly all of the issues, and ever since January, what we've sought to do is really provide guidance in the form, proposals maybe in the form, so that the community and potential borrowers knew the process that we thought was best for Maker, that was structured so that we received MIP applications that were as comprehensive as possible. So if you look at the methodology for structured finance transactions, which we published in January, it's very, very detailed as to some of the criteria we're going to be looking at. Now, every transaction is going to be different. A project finance transaction is not going to be the same as a structured finance transaction. I get it. But you should be able to address in some form or fashion in your application all of those issues, because those are all the questions we're going to be asking you. So, I mean, we're giving potential borrowers a roadmap to how to get their MIP, efficiently reviewed. And that's the key. We're not, the community could decide that it just wants to accept whatever MIP comes in the door. That's fine. Or the community could decide it wants a different set of standards. Maybe Maker wants to be more equity-like rather than more debt-like. Well, that's a completely different risk profile. And as Eric said, you're not taking equity risk for a debt-related return. So it's no longer 1 or 2%. It's maybe 15% or 20%. And borrowers will always want, and with an inexperienced lender, borrowers will certainly try to pass equity risk on to the borrower. Why wouldn't they? Okay, I can give you 2% return and you can take more equity risk. Well, that's not what borrowers tend to want to do.
And that's the other thing is to potential borrowers, when you look at that structured finance methodology we published, that's probably 6 or 8 pages, or heck, maybe even more. I think what I would say is, look, these are the issues you need to be able to engage with us thoughtfully with, or with Maker. Any lender is going to want these, And if you're not fairly well versed in these issues, you probably should get, good legal counsel and probably like some kind of financial like advisor and investment banker, who does know these things. I mean, there's a whole lot of stuff there, and getting to a yes and finishing a transaction requires a level of fluency in those issues. And if you just don't have that fluency, and if you don't have the help, it's going to be a mess.
So
It's
Eli,
not gonna help you prioritize your transaction, honestly, because it becomes a huge time suck for us.
yeah. So Eli asked a question about the current prioritization list and which MIPS are in which order. Um, so there is, so I'm speaking off of the top of my head. So we're working on SocGen and trying to get SocGen across the finish line. That is probably the first prioritization. It changes week to week in terms of what follows next. We have had over the last 2 weeks, I think 5 self-contained MIPS, and perhaps 2 that were unclear as to whether they were MIP6s or self-contained MIPS. And because of these self-contained MIPS, we're going up to a vote, and the vote was then binding on the community. We felt that we had to address those first. So for the last 2 weeks, we have been working to provide comments to the various self-contained MIPS that were onboarded, posted a couple weeks ago. And as Monkey Irish has said, there will be a new collateral status index, which is going to be providing details on all the collateral. I think one of the things you'll have seen is that I know one of the previous MIP6 withdrew their application today. So we're trying to clean up that prioritization list. So right now, first and foremost, the asset that has been approved by the community and is in the implementation stage at SocGen.
Perfect. It looks like we have another question here from David. David asks, for the most part, or for most of the MIPS that I have seen, I believe the fundamental question we need to be asking is why Maker, especially as most of the deals I have seen require the additions of new intermediaries over and above the TradFi intermediaries, raising the cost of managing these funds. What is the motivation of using Maker as a funding source? Shouldn't we ask this question first to even ensure that the transaction makes sense for Maker?
It's a great question. Let me give a few thoughts. Besides, it's a great question. There's some folks, that want to do business with us. They see it as strategic, to start building, perhaps like they're in the real world, and there's a lot of real world firms circling around DeFi, and they'd like to establish a presence. And we've been approached by a few, billion-dollar credit hedge funds that are interested in working with us, and I think they see that as kind of adding to what they're doing. And let's be honest, it probably makes them look more sexy when they raise money from their limited partners to their investment fund. I mean, that's great. There's a lot of interest coming, but I think, and also say we're hopefully almost here on deal in SocGen, where they see it as kind of showing a proof of concept. So I think it's fair to say when we're looking for people that want to work with us, we do want to understand why, because it's not as easy to do a deal with us as it, or if you're a big sophisticated borrower, it's easier to go to JP Morgan Bank and do a deal. Why would you come to us? At least initially, as we start building the pipes to get it done, it's harder. There's more brain damage. Hopefully, as we do more deals, it's going to get a lot easier. But initially, you're right, it's more headache. So we're typically looking for people that see some strategic value in working with Maker, for like SocGen.
And I would say, like, for somebody like HVB Bank, I think they have viewed the opportunity as what they have been doing in the U.S. Say, through the through the various COVID relief programs, in terms of being able to access, quote, the Federal Reserve. They kind of see how they have been interacting with the U.S. government in a way similar to the same type of funding for Maker. And to them, it's, I think, a similar concept, which is they're able to then, and this is where Maker can really help, right? It's because it can work with a bank like HVB or others to actually open up more access to markets, because we're going to be able to provide HVB the ability to make more loans, because they would, for instance, be, selling us participation, which would reduce their balance sheet exposure. So for them, it's a very strategic move.
I guess the other thing I'd say is it's not our call, but I think we would recommend for some of these earlier deals to get going that maybe Maker, give people a little better than typical market terms that they want to do business with, because we want to get these first deals done and show that we have a good footprint in the real world and can do lots more deals, and sometimes to get the first credible customers in the door, you give them a better deal than you're going to, down the road. And that gets, like, once we do a few big deals that are well known in the space, my sense is we're going to get dozens of people lining up.
And I think the question on the intermediaries, I don't know necessarily that we have more intermediaries than a traditional deal, because if you look at a traditional structured finance deal, the lender's not going to be just lending money to the borrower and saying, hey, send me a check whenever you get around to it. I mean, there's definitely going to be very tight and established controls in that process, whether it's through working through an indenture trust, working through a Delaware statutory trust. I mean, they're very well-defined processes in the real world.
No, Christian, to your point, I'd say
we're just trying to build on top of that.
Christian, in a structured, in a more of a securitization, you could have a third-party servicer, a third-party backup servicer, a trustee, a collateral agent, a custodian. I mean, there could be a whole lot of different third parties making sure this whole thing works.
Yeah, perfect context. As a quick follow-up to Eli's question about prioritization, I want to make sure that for the recording, Robert Johnson, Monkey Irish from CES, said that before the GNR call tomorrow, he'll be publishing the new collateral status index, which will provide details on the collateral moving through the onboarding process. So definitely keep an eye out for that. With that, I believe we're at the top of the hour and there are no other questions in chat. So I want to thank Christian and Eric, and then also highlight that I believe you guys have office hours coming up as well in about an hour, if I'm not mistaken. So there are more opportunities to engage with the team, especially on a more one-on-one basis in office hours in about an hour. Check out the MakerDAO public calendar for that. The recording of this call will be hosted on the MakerDAO YouTube and shared in the forums with the focus on post. So Christian, Eric, if there's any final words you'd like to say to wrap this up, the floor is yours.
I've said enough.
Yeah, thanks to everybody.
Perfect.
Thank you.
Yeah, no, appreciate it, guys. Lots of good context today. So thank you everyone for joining, and we'll see you in the forums.
Thank you.